Okay. Well, let me show the screen. Before I show the screen, well, I had some questions from other groups about the home task, homework. Yes. Mm, some students have problems with the numbers in the S&P 500 index. Yeah, so do not copy it from the Google spreadsheet, but rather download the spreadsheet as an Excel file, and then you won't have any problems with the numbers. Okay, I don't like, I'm not sure that it is relevant for you, but if you have some problems with the numbers, just download the spreadsheet in Excel format. Okay. Well, we have something unsolved and undiscussed from the previous seminars. So let's discuss some questions. Firstly, they are quite connected with today's topic because we are going to proceed with the risk portfolio theory and start to work with capitalized pricing model. Well, if we talk about the risk and the portfolios, we can combine some shares, some stocks in the portfolio, and shares and stocks has their correlations. In which of the following situations we are going to get the largest reduction in risks by forming a portfolio?
May I answer, please?
Yes, you can.
There is a perfect negative correlation because
Why?
if the price for one stock is decreasing, the price for another stock is increasing. So if you lose in one stock, you will gain in the other stock.
Yes, probably the return will be very low for this portfolio. Yes, but the risk will be almost near to zero. Okay, that's nice. Let's discuss such a question. So we have two companies, some strange names. Yes, they has the standard deviations and they has the betas. And I tell you that the first company is the better investment for a diversified investor. But you can argue with me because the standard deviation of the first company is higher than for the second one. Yeah, so why I tell you that the first company is a better investment opportunity for a diversified investor?
Because, if I'm not mistaken, because beta is a representation of the correlation, and as it's small, it means that the correlation is small, then the risk is small too.
The correlation of what with what?
The correlation of this probably these two companies. Oh no.
No, beta is the measure of sensitivity to the changes on the market, the change of the market return, right? Yes, and the standard deviation is the measure of the specific risk for the company, right?
Okay.
Well, so why here we look at betas and not on the standard deviations? So we have
compare them with the whole market.
So we compare them with the whole market. Yes, with the beta, yeah, but Why we look at them, but not understanding deviations of these stocks when we're choosing in what stock to invest. Well, actually, the standard deviation is the measure of the systematic risk of the stock. Yes, and I'm sorry, not systematic, but specific risk of the stock. And if we have a very diversified portfolio with a lot of stocks in them in it, the risks of these stocks will be mitigated totally. Yes. So if we add this stock to the portfolio, the standard deviation of the stock won't affect the risk of the portfolio in general, because it is the portfolio is highly diversified. Yes, but if we add the stock to the portfolio, the risk of the whole portfolio will be higher if the beta of the stock will be higher, because it will react on the changes of the return on the market in it will react more dramatically to the changes on the return on the market. Yeah, but we should not look at standard deviations here, because in a diversified portfolio the risks will be mitigated. Yeah, so we will have only market risk, which is measured by beta. Okay, is it clear?
Yes.
Nice. Okay, well, true or false, our favorite. True or false, we have 5 statements. Let's write in the chat, what do you think about the statements? Please write for all of them with one message, okay? I will be silent for a couple of minutes.
Можно ответить? Можно? Пожалуйста.
Well, please write just write in the chat what you think about the statements, and then we can discuss with you also. Okay, Polina, what do you think about the first one? Why is it false?
Yeah, so we know that investors prefer diversified portfolios, but diversification of company, I think that it doesn't make it less risky. So that's why I decided that this statement is false.
Mm-hmm. Yeah, probably the diversification of company can make the company less risky, but it is still, well, if we compare a portfolio of 100 undiversified companies and a portfolio of one company, but it will be diversified, actually it is better to invest in a portfolio of 100 undiversified companies than in one company which is diversified, like I don't know, Yandex, for example. Yes, if you have a portfolio of one stock, it will still be very risky. Okay, so yes, it's false. Well, what about the second one, Christina? What do you think? Christina, are you here?
Yep, I'm here. I think that it's true. I just don't know what to say else.
Why it's true? Okay, why it is not a good idea to buy perfectly positively correlated stocks and form a portfolio of them?
Can you repeat one more time the question, please?
Okay, you are considering buying 2 stocks. You know that they are positively and perfectly positively correlated. Why it is not a good idea to form such a portfolio?
Because it doesn't affect your risks.
And why it doesn't? Okay, maybe someone can help. Christina? Konstantin, what do you think?
Yeah, because of the formula of the calculation of portfolio risk, we use metrics where in the matrix position 1, 2, and 2, 1, we have the correlation coefficient, and if it's positively, we will sum all the values. And if it's negative, we will reduce these values.
Yeah, by the formula, of course, but also on the common sense, if we are buying 2 stocks that are positively correlated, if the price of one stock will fall, the price of the second stock will also fall definitely. Yes, that is not a very good situation for us. Okay, what about the third one? Let me look at the chat. Daria, what do you think? Yeah.
The third one, right?
Yeah.
Well, it is false because the risk eliminated by diversification is called specific risk. There will always remain some risk.
The market risk, at least.
Like market risk.
Yes. And also the specific risk also cannot be mitigated like completely. We will still have some little part of risk because you have seen the graph. So the specific risk cannot be like equal to 0. It can be very, very close to 0, but not equal to 0. Okay. A stock with low standard deviation always contributes less to the portfolio risk than a stock with a higher standard deviation. Aygul, what do you think about it?
I think this is false. Due to the reason that we just discussed, because if we want to compare 2 or more stocks, we want to compare their betas and not standard deviations.
In a diversified portfolio, yes. So yes, so we should look at the betas, yes, for these stocks, and also if we are comparing, or if we are forming a portfolio of 2 stocks, the risk of portfolio will be calculated by the formula that we know, and the standard deviation is not the only parameter in the formula. So we will also have the shares of the stocks in the portfolio, right? And if the share of a low standard deviation stock will be very, very high, 99%, for example, it will contribute more to the portfolio risk than a stock with a higher standard deviation, but in a very, very little proportion. Okay. The contribution of a stock to the risk of a well-diversified portfolio depends on its market risk. So, Tatiana, can you comment on that?
Yep, actually, the well-diversified portfolio is a portfolio where the weights of securities are small, and then the security any of the portfolio does not affect the overall risk of the portfolio a lot. So the risk of the portfolio will be approximate to the market risk.
Yeah, and if we, for example, add some stock to the portfolio, so how it will contribute to the risk of the portfolio? We again look at the beta, yes, and if the beta is high, probably the contribution will be higher. So it is again dependent on the market risk. Yes.
Yep.
Yeah. So if for example the market like the market portfolio return will change by 10%, and we add some stock that has 0 beta, the market portfolio return will change like by 10%. Yes, but if we have some beta, the return of this stock will also change with some coefficient. Yes, for example 0.6. So the change in return of the portfolio will be higher. Okay.
Yep.
Well, let's consider another question, again about systematic and unsystematic risks. I have 6 risks here. Let's think whether they are systematic or unsystematic. So whether they are affecting all the companies in the economy, or they're affecting just some companies or just one company. The first is about short-term interest rates. We have a risk that they can increase unexpectedly. Is it a systematic or unsystematic risk? What do you think? Well, probably it's still better to raise the hands. Yes, in order not to speak simultaneously. So, Georgi, what do you think?
I think that the first one is unsystematic because short-term interest rates is much more random than long run. So am I to go to the next letter? Or
yeah, actually, when we're talking about systematic or unsystematic, we are not talking about like how much they are like expected or unexpected. Yes, risks are always unexpected. Yes, and some of them can be forecasted, some of them are hard to forecast. But here, if we're talking about systematic or unsystematic, we are talking about market risk or specific risk of the company. Yes, systematic risks affect all the companies in the economy. The market risks or the specific risks or unsystematic risks affect like one company or a group of companies. So these short-term interest rates, like if we speak from this perspective, short-term interest rates increase affect all the companies or just one company?
May I answer? Like systematic affects the whole market, and unsystematic affects a specific industry or company, right? So that's why A is systematic, because short-term interest rates, they affect the whole market or the whole system, let's say.
Yeah,
in other words.
All the companies in the market. Okay. And what about the second one? If the interest is raised by the bank of some company or some specific body.
May I answer this question?
Yes, Diana.
Okay. I think that interest rate, mainly debt is not increased with time, but it's decreasing, because if we're speaking about the bank system, the most interest rate on payment, something like this, it is decreased with periods, because in the beginning we pay for the interest mainly, and principal payments are less, and after it principal payments grows, but interest payments decrease. So we have another connection here. So I think it is unsystematic, because systematically our short-term debt borrowing decrease. Maybe I'm not right, maybe I'm speaking about another thing, but
yeah, again, systematic is about what is affecting all the companies in the market. Yes, unsystematic is the specific risk of some company. Yeah, here the interest rate on this short-term borrowing is increased by the bank of some company, and probably on one borrower.
Yes, probably once it may happen, and that's why it might be unsystematic, but systematically it works vice versa. I think, because systematically the debt is decreasing.
Yes, again, so don't like put synonyms between like systematic and like usual, or how to say. So you mean that systematic is something that is like expected and that's happening like usually, yes? Right?
And you speak about what happens from period to period, and about the
not exactly. I'm speaking about what risks affect all the companies in the economy. For example, the short-term risks, short-term interest rates increase.
About the how global this risk is.
Yeah, how global this risk is. And unsystematic, they are the risks that affect like a group of companies or only one company, like in this case. So the interest rate for some company on some debt borrowing is increased. Yeah, so that's unsystematic, or the specific risk of the company. This risk is systematic or market risk.
The interest rate a company pays on its short-term debt borrowing is increased by. Okay, in this case, it's systematic. Yes.
It is a specific risk of this very company, so it's unsystematic.
Окей. Окей. Я просто подумала, то, что я же ответила unsystematic, а вы так начали говорить, то, что я о чем-то не том думаю, я подумала, что я не тот ответ дала. Вот. Ну, короче, да, unsystematic. Топим за unsystematic.
Right answer, but the logic was
incorrect.
Okay. What about the oil prices? Alena, what do you think about the oil prices?
I think it's a systematic risk because oil prices are related to the currencies. So, for example, in this case, if oil price declines, so if we take, for example, ruble, it will decline also, and this will negatively affect all the industries in Russia.
Yeah, actually,
there was
the statistics recently. When oil prices rise, the ruble also declines. So that
okay. Well, it's anyway
systematic. How that works. So, but yes, for the examples that you gave, this risk will be systematic, right? But can it be unsystematic for some countries?
Maybe
for some
it
regions?
can be, well, if a country's economy doesn't really depend on the oil, maybe it depends on some service or service industry. It may be unsystematic for this country.
Yeah, for example, take, I don't know, Switzerland. I don't think that oil prices are oil price risk is a systematic risk for Switzerland. There are some companies that are dependent on oil prices somehow, yeah, but it is mostly unsystematic in this case. But for Russia, it is actually systematic risk. Okay, and what about the oil tanker that ruptures, creating a large oil spill? Diana, you have raised the hand. What do you think?
I just forgot to remove it, but I can.
Okay, but what do you think about this one?
About D.
Mm-hmm.
An oil tanker reputes create a large oil spill. I think it's maybe unsystematic because it sounds like it doesn't happen to each company in the market, but
yeah, so it happens
like
one.
yes, like it's happened once, and that's why it's unsystematic.
Yeah, there can be some outcomes related to ecology issues, and maybe in some short-term period, all the prices for oil companies can go down. Yes, for a while, but still, I think that oil tanker issue is just an issue for one company, so it's systematic risk. Yeah. Okay, and manufacturer loses a multi-million-dollar product liability suit. Aruzhan, what do you think?
Well, I think that this is unsystematic. Why? Because it affects only one manufacturer. So it doesn't affect the whole market in this case.
Yeah, that's right. And what about the last one? Arina, can you comment on the last one?
Same, it's probably the unsystematic because it's only about one producer. So yeah, it's unsystematic.
Yeah, maybe some other suggestions. So why do you think that it is about one producer?
Because the producer is in one, how's it called?
I see.
There
Okay.
is no S in the end, so
here
I
it
thought that
it is meant that this
this is
here it is
statement
meant
about
that
one
the
producer.
Supreme Court decision like is for all the economy. Yes, so the Supreme Court is some court that makes very important decisions about all the economy. Yes, and it substantially broadens producer liability for injuries. So it means that for any of the producers, the liability will be broadened. Yes, like this. So it's actually systematic.
Okay, I understand.
Okay, well, the last question before we start in our calculations. If a portfolio has a positive investment in every asset, can the expected return be greater or less than the return on every asset in the portfolio? Is it possible?
I guess the first one. I'm sorry. Can I answer?
Yes.
Well, talking about the first one, I guess this is no. Why? Because the expected return of the portfolio is a weighted average of the returns from those assets. And, well, yes, the expected return must be less than returns from the largest asset, but greater than the returns from the least, well, smallest asset.
Yeah, so it is always somewhere in the middle, yes, between the least return and the highest return. Yeah, and when I'm talking about positive investments, why should I need this positive here? Can the investment be negative? Or can the fraction of the stock in the portfolio be negative, like minus 20%, for example?
Actually, I think that investment can be negative if it costs more to hold than we have in return in payments. So it can be negative.
You mean the negative return, right?
Yeah.
Yeah, the return can be negative, but the share of the stock, like we invested some money in the stock, in stock 1, stock A, stock 1, stock 2, and etc. And they have some shares in the portfolio. Yes. Can the share be negative? Yeah, actually, it can be negative because we have an opportunity to open the short positions. Well, who have heard about short positions? So when we invest in stocks, like ordinary, we firstly buy stocks and then sell them, like in some time. But in the case of short position, we firstly sell the stock, and then in some time we buy the stock. If we expect that the price of the stock will go down, we can open the short position, sell the stock without even owning it, and then buy the stock. So we sell it for the current price, and then buy the stock in some time for the price that will be on the market. And in this case, such kind of investment will be negative, and the share of this stock in the portfolio will be also negative. Yeah, because we have sold it in advance. Okay, let's move to the calculations. Let's open the spreadsheets. I will delete this. Well, so the first exercise is connected with what we have done on the previous seminar. So we have 4 kinds of financial instruments: treasury bills, stock P, stock Q, and stock R, with their returns and their standard deviations. The task is actually to find the standard deviation of 2 portfolios. One portfolio will be 50% in treasury bills and 50% in stock P. The second is 50% in stock Q and 50% in stock R. For the first portfolio, we should calculate the standard deviation in like one standard deviation. For the second, we should calculate it in 3 variants. So assuming that the correlation between stock Q and stock R is 1, 0, or -1. And why shouldn't we do the same with the first portfolio? So what correlation we assume here when we are going to calculate the portfolio of treasury bills and stock P? What correlation between? Yeah, why?
It's just prediction.
Yeah, but actual correlation between treasury bills and the stocks is 0 because the return is stable. So we have 6% of return, and the standard deviation is 0. That means that the return doesn't change, yes, over time. It doesn't fluctuate. That's why we have no correlation between the return of treasury bills and the return of stock P, which actually fluctuate. So here we have only one variant because the correlation is 0. Yes, here we need to assume something. So, and we here assume that the correlation is 1, 0, and -1. Yes, and have 3 different answers. Okay, so raise the hand, please, when you are ready. Okay, I see the hands raised, so let's start discussion. Konstantin, you were the first. Let's talk to you.
Yeah, okay. So can you please another time explain? We have the no correlation between because the treasury bill has fixed return, so the deviation is 0. Okay.
Yes.
So we just use the formula of calculating the standard deviations, but because the correlation is 0, we do not took into account the correlation, and because treasury bills have 0 standard deviation, we also removed, and we just obtain the standard deviation of our stock P.
Mm-hmm. Well, let's look. So you have the return squared, and why should you use
no return? Yeah, only the share. But also return. Why we have return here?
Yeah. So, but what you have calculated is actually the variance, probably. Yes, not the standard deviation.
And you square it. Yeah.
Yeah, like this. So it's the square root of. Actually, we should take shares in squares. Yes, so 0.5 squared.
And why we take percents when we use standard deviation? Because of the visualization, or because it's more easier?
You can, like, it is more understandable. So the mean return is 10%, and on average it can deviate by 14 percentage points. Yes, it's like easy, but you can use percents, so you can use like this. It's like for the visualization and for the convenience. Just
okay.
Okay, yes. So we have the share in square multiplied on the standard deviation of stock P, and for treasury bills we have
0 standard deviation, and for that reason I do not include it.
Yes, and make a square root of this stuff. Okay. Well, Aliona also raised a hand.
Yes.
Let's look. Let's find. Okay. Well,
yes. So basically follow the same logic. So we use the formula for the variance, but it's square root, so it's standard deviation. So we know our shares, and we know our standard deviations, and then we see that, well, basically it's the same for all free cells, but the difference in correlation only.
Yeah, but actually you are using, sorry, let me show it.
I'm using the basic.
You're using this formula, yes. Yeah, and actually in the cases of this perfect positive, perfect negative, and 0 correlation, we can use simplified versions. So maybe someone have solved with the simple versions. No?
But it's so difficult to correlate it in Excel with different formulas, when we can just use the simple one.
Yeah, but actually this is longer than some simple one. Okay, let's look at the example. Yes, for example, if the correlation is perfect negative correlation, so -1. Let's look how we can calculate it. So we can take the share of the stock Q in the portfolio multiplied on the standard deviation of stock Q minus the share of stock P, stock R in portfolio multiplied on the standard deviation of stock R. Yes, then we can take it in brackets and use the function ABS, which is for absolute or module, yes. And we get the same result, yes. So using this formula, module of just share of the first security multiplied on the standard deviation for this security minus the share of second security multiplied on the standard deviation of the security. Okay, so you can use these simplified formulas if you need them, yes. But of course you can use the long one because it's universal, yeah. Okay, is it clear for everybody?
Yes.
And I have a question here. So stock Q has lower return, 14.5 compared with 21 of stock R. Yes, but higher standard deviation, 28 compared with 26. Does that mean that the price of stock Q is too high, or the stock Q is overvalued, or that price of R is too low, or the stock R is undervalued? So can we judge in this case?
Maybe we can say that the stock Q is overvalued.
Maybe. In what case we can say that? We can say that in the case if we assume that the price of stock R is the fair price, and actually the return of 21% is that return that we should have given the standard deviation of 26%. Yes, we should look actually at the betas for these two stocks. Yes, and allocate the stocks on the security market line. Yes, if stock B is on the line, oh, I'm sorry, not B. If stock R is on the market, on the security market line, somewhere here, for example, then we are going to say that probably if stock Q is under this market line, then it is overvalued. Yes. So we need to have some additional information to judge if these stocks are overvalued or undervalued. Yes. So if you see this situation that the return is like the return for stock Q is lower, but the standard deviation is high, it doesn't mean that the stock Q is overvalued. Maybe both stock R and stock Q are undervalued. Yes. Maybe like it is a very good return for this standard deviation. Yes, maybe the return for standard deviation for standard deviation of 28% should be 10, for example, on the market. Yeah, so these two stocks are undervalued. So we cannot judge only looking at these two values. Yeah. Okay. Let's move on. And please, guys, hide the previous seminars, please, because it's very difficult to find the today's tasks. Okay, so I have copied the task. Here, what we have here, we have several stocks with their betas, yeah, and we have treasury bill rate, which is actually risk-free rate in the market. We have the expected return on market portfolio, which is 10%. We have several questions, but actually to answer these questions, we just need to calculate the expected returns of these stocks, given these betas, given this treasury bill rate, and the expected return on the market. By the way, how should we calculate the expected return in this case? What model do we use? No suggestions?
Maybe SLM model from the previous lecture.
SLM?
Well, yeah, that one, but SML, no SLM.
Yeah, so security market line. Yes, it is connected with security market line. Yes, it's called capital asset pricing model. Yes. So the expected rate of return on this very stock is depending on risk-free rate on the market, the beta of the stock, and the risk premium for investing in market portfolio. Yes, so the difference between the market return rate and risk-free rate. Okay, let's calculate the expected returns and then this. Okay, Aruzhan, can you show your solution, please?
Oh, sure.
And by the way, can you please provide me with the Google email, because you're the only one with unprotected spreadsheet here.
Oh, yeah, I wanted, if it is possible, I will send you the...
Yes, it is possible.
So thank you. Yeah, probably I haven't done the whole exercise like this. Well, first of all, I used the formula for the expected return that we discussed like several minutes ago. just using well, treasury bill rate, which is 6%, then we should use the further formula, like plus beta multiplied by the difference between the expected return of the market and treasury bill rate. Yes, so, and then answering the questions, I guess the highest expected return, as we see, Amazon has.
Yeah.
Yeah. And the lowest is owned by Campbell's Soup.
Yes.
The last one.
Actually, that's obvious.
Yeah. Well, would Ford offer higher? Okay.
Yeah, this question is quite interesting. So would Ford offer higher or lower expected return if the risk-free rate was 4%? Of course, we can just change 6 to 4% and check it, yes? But let's firstly discuss on the common sense. What are we expecting if the treasury bill rate will go down? Or not actually on the common sense, but like just before we check it, let's discuss what we're expecting. So, for example, this treasury bill rate, the risk-free rate, will go down by 2 percentage points to 4%. Yes. Do we expect that the Ford will then provide higher return or lower return? What do you think?
I guess higher. Why? Because I imagine the formula in my head all the time. No, so we see that the difference between the treasury bill and a market rate, expected return rate, will be higher. Then it basically means that we will get higher expected return. So.
Yeah. So, and if we look at, for example, the graph here. Here we have risk-free rate. If it will go down, it will be somewhere here, and the line will go like this. Yes, that means that for companies which are situated here on the line, as Ford, yes, because Ford has a beta of 1.75. Yeah. Ford is situated somewhere here. Yes. When the line will change, it will be like here. The Ford will be situated somewhere here with a higher return. Yes. And we check it. Yes, and you have calculated that the return in this case will be 14.5. And what about ExxonMobil? If the return, if the risk-free rate will rise by 2 percentage points to 8%, ExxonMobil is here. Yes. Will the return be higher or lower?
So for the same, I guess, reasons, it will be lower. I mean, from the graph, if we look at the starting points at the Y line, so the slope will show us that the expected return will be lower.
The risk rate will rise here, and the line will go like this. Yeah. And for Ford, for example, the return will be lower. But actually, ExxonMobil is situated somewhere here. It has a beta of 0.55, right? So it's somewhere here. When the line will change, it will be upper. That's why it will provide higher expected return, right?
Higher? Well.
Yeah, well, can I draw lines in Teams? I don't know. Check it.
I guess you can somewhere.
No, I don't see such an opportunity in Teams. Fortunately. That's why maybe Zoom is better. Okay. Well, so the line will go like this, yes?
Because beta is less than 1.
Yes,
Yes.
better for ExxonMobil less than 1. ExxonMobil somewhere here. When the line will change, ExxonMobil will move somewhere here.
Oh, okay, yeah, I get you now. So it
Yeah,
also will be higher.
Yes, yes, it also will be higher. So, and if we're talking about the expected return, actually, what is it about? How can we use it in the real life? So it's not the real return that the stock provides, right? It's something that is expected. So it's something that is predicted by this theoretical model. Yes, we take some inputs and then predict how, like the return that should be provided by this stock. How can we use it in real life?
So we can see whether we have a profit or loss because we just make a forecast. Yeah, and
so for forecasting something, yes.
Yeah.
Okay. What else? So if we see, for example, that the expected return is lower, that then the stock really provides. What does it mean?
You shouldn't invest. There are better options, I guess. No.
So if we see the expected return should be lower, yes, but the stock provides high return, it means that the stock is actually undervalued. Yes, so we actually can expect that the price will correct. Yes, and in order to provide the investor with the expected return that is like that should be from this stock. Yeah. But also we have used actually this expected return on the last, not on the last, but on some of the previous seminars. Where can we meet this concept in our formulas? For example, when we are valuing a stock, which will provide us $100 of dividends every year in perpetuity, how we are going to estimate the value of the stock, the price of the stock now?
Just multiplying this number by the expected return, and that will be our forecasted profit, and we will get forecasted profit or loss.
Yeah, so the forecasted profit is actually our dividends, yes, our forecasted cash flows. So we are going to have 100, yes, $100 in perpetuity every year. But how we estimate the stock price? Well, maybe your group mates can help you. Konstantin, what do you think? How we calculate?
You mean dividend divided by the rate minus growth?
Yeah, the dividend discount model, right? For example, the growth is 0% expected. How we, for example, let's take Ford. Yes, we are saying that it will provide us with $100 every year in perpetuity with dividends. How much should Ford cost today? How much the stocks of Ford should cost today?
We should divide 100 by expected return.
Yeah. So the expected return is the discount rate in our formula. Yeah, so the price of Ford, the fair price of Ford is 769. Yeah, if we expect these dividends in perpetuity. Yeah, so that's how we actually calculate our discount rate, our minimum required rate of return on this stock. Yes, that we use for creating the stock and discounting our cash flows related to this stock. Yeah, so on the previous seminars we had this rate given. Now we can estimate this rate knowing some parameters: the beta, the risk-free rate, the expected return on the market.
Yeah, thank you.
Okay.
I get you.
Is it clear for everybody?
Yes.
Yes.
Okay, that's nice. So you can make a link with the previous seminars when we valued some stocks. Yes, that's how we estimate the discount rate. Okay, let's return to the slides for a while. We again have true or false. Let's do it one by one. Okay, the CAPM model implies that if you could find an investment with a negative beta, its expected return would be less than the risk-free rate. Is it true? So we can just look at the formula.
Yeah, as it was in my task. So we have negative beta in the formula. And it will produce.
Yeah, in your task you had positive betas. Yes, they could be less than 1, but they were positive still. But if you have negative beta,
it will proceed the lower return.
Yes. So if we find such an investment with a negative beta, yes, the expected return for this stock will be less than the risk-free rate. Well, it means that when we are going to value this stock, the discount rate will be less than risk-free rate. That means that the price for such a stock will be quite higher. Yes, because like if the risk-free rate gives us 5%, for example, this stock will, the expected return of this stock will be, for example, 3%. Yes, so the price will be quite high. So all other equal, the price will be quite high. Okay, what about the second one? The expected return on an investment with beta of 2.0 is twice as high as the expected return on the market. Is it so?
No, because we also consider the return of the risk-free.
Yeah, so the expected return is calculated by the formula, right? So, and if beta is 2, then it means that like it won't be twice as high as the expected return on the market, but the change in return, yes, of beta, yes, no, I'm sorry, the change of return of this stock will be twice higher as the change of return on the market. So because beta is the measure of volatility against market. So the market falls by 10%, the stock falls by 20% in this case. Okay, if a stock lies below the security market line, it is undervalued. Let's look at the line. Is it true?
It's false.
Christina, yeah.
Yeah, because if the stock is below the security market line, then it's overvalued and its price has declined, so that the expected return can increase.
Yeah, so if the stock is below the security market line, it means, for example, for stock A here, that for beta of 0.5, it, in theory, it should provide this rate of return, yes, given the market line, but it provides only this rate of return. It means that the price for the stock is very high and should be corrected, should be lowered in order to this stock to provide the theoretical return, yes, the expected return. Yeah, so it's false. Okay, and the CAPM model predicts that a security with beta of 0 will offer a 0 expected return. Is it true?
Yeah.
I think
You
no,
we have
because we
Well,
still like
yes.
there is the formula, and the beta is multiplied on the one part, but we still have this risk-free part, which is not depends on the beta, so it will be the just not the zero, but the risk-free.
Risk-free rate.
Yeah.
Yes. Yeah. Okay. Nice. Well, let's move on. We have one more task for today, and then we're going to finish. So if we look at the capital asset pricing model, we have the expected return is equal to the risk-free rate plus some beta and multiplied on some premium for investing in market portfolio. Yes, it is the premium for investing in a portfolio that has only market risk. So in a diversified portfolio. So is it clear for now?
Yes.
Yeah, so this R with little m is the rate of return of the portfolio, which depends, which is affected only by market risk. It is the diversified portfolio. No specific risks affect this portfolio, only market risk. Yes, and here we have again risk-free rate, beta, the rate of return for the portfolio that is affected only by market risk, minus risk-free rate. And we can turn to a more broad model, arbitrage pricing theory. And here we'll have the same formula, but with like many factors. So the return, the expected return of the stock is equal to the risk-free rate plus some coefficient beta and some risk premium. This risk premium is calculated in the same way as in CAPM. So here we have the return, the expected return on the portfolio, which is affected only by one risk, yes, by some risk factor, minus risk-free rate. Here we have the rate of return on investment in the portfolio that is affected by only by the risk factor 2 minus risk-free rate, and etc. Is it clear for now? Because it's quite maybe difficult to understand. So what does this mean? So we form some portfolio that is affected only by one risk. No other risks has an effect on this portfolio. Yeah. And we calculate the return for this portfolio minus risk-free rate, and we're having here the risk premium for investing in such a portfolio which is affected only by one risk. The same as in CAPM model. Here the risk is the market risk. This is the portfolio which is affected only by market risk minus risk-free rate. This is, here this is the rate of return of a portfolio which is affected by some other risk, yes, and only this risk minus risk-free rate. Is it clear for now?
Yes.
If you have some questions, let's discuss it now, because it is quite important. Okay, the other question is how to calculate these portfolios, and it is not in the scope of our course, but you can, and probably I will send you some information of how this formula is derived. So we are starting from just making a regression of the return of the stocks, of some benchmark stocks at like we regress these returns on some risk factors and calculate some beta coefficients and etc. And then make some mathematical operations, and in the end we're going to have this formula. So the expected return on the stock is equal to the risk-free rate plus some beta coefficients multiplied on the risk premiums for investing in the portfolios which are affected only by one risk factor, one corresponding risk factor. Okay, let's try to solve problem on this topic. I will copy two problems. One we're going to do now, and one you can try to solve at home. Yeah. So we have here three risk factors: change in gross national product, change in energy prices, and change in the long-term interest rates. The risk premiums for these factors are the following, like 5%, -1%, and 2%. We are talking about these parts. So for the factor of GNP, the risk premium, this thing in brackets, is 5%. Risk-free rate is 7%. Let's calculate the expected rate of return of some stocks. Let's start with a stock whose return is uncorrelated with all three factors. When we are talking about uncorrelated, it means that the betas here are zeros. So how we calculate it, then can you help me?
So it's just a simple risk-free rate?
Yes, because
beta is zero.
Yes, other terms are zeros. Okay, so it's just risk-free rate. Well, what about B? A stock with average exposure to each factor. It means that average means that the betas are 1 for each risk premium. Yes, for each risk factor. How we're going to calculate it?
Can you show the A1 task? So we just copy the risk-free rate because of the no correlation?
Yeah, because the betas will be 0, so it will be 0 multiplied on this, plus 0 multiplied on this, plus 0 multiplied on this.
Is correlations for the factors, yes?
So the expected return of the stock is uncorrelated with the risk factor. So the risk factors does not affect this the return of the stock. Yes, so we can say that the betas are zeros. Yeah, here in the second case, all the betas are ones because the dependence of the return on these risk factors is like average, like for some portfolio on the market. Yes. So how we calculate it? We take risk-free rate and then put all betas as 1. So 1 times 5% plus 1 times -1% plus 1 times 2%. Yeah. Okay, what about the third one? Maybe someone has solved it already.
Probably the same, but we need to multiply all the changes by 2.
All the changes, or just, I guess, just the energy factor? Yes, changing energy price.
Okay.
So we just sum risk-free. Yeah. And energy multiplied by 2.
Yeah. Yes, and others will be same.
But we have 0 exposure, no? So 0 beta.
Yeah. You're right. Yeah, so it will be 5%. So we see that the risk premium for change in energy prices is -1. Yeah. So we have lower expected return in this case. Okay, and for the last, we're going to have 1.5 to the energy factor and once, yes, and the average sensitivity for other factors, which means that the betas will be 1. So it will be risk-free rate plus 1 times change in GNP factor plus 1.5 times change in energy prices plus 1 times change in long-term interest rates risk premium. So it will be like this. Okay, so actually this model, yes, is like a more broad option of CAPM model. Or in other words, CAPM model is just one example of this arbitrage pricing theory model. Yeah, so you should understand that we are not only using CAPM in real life. Sometimes if we want to see the sensitivity of the stock to some other, if we want to capture the sensitivity of the stocks to some other risk factors, but not only market risk, then we can use like any risk factors, calculate the risk premiums for every factor, and estimate the expected return of the stock. Okay, is it clear for now? So do you have any questions?
No.
I think now it's more clear than before. 100%.
Okay, that's nice. Okay, so let's then finish. If you have some questions in Russian, we can discuss it after the seminar. And I wish you like New Year. How it's said in English. Happy New Year and Merry Christmas. Yes. So please enjoy your holidays. Don't forget about the homework because the deadline is near. Yeah? And good luck on the session week.
Thank you. Happy
Thank
New
you,
Year.
you too.
Thank you. Bye.
Thank you.